Okay, good afternoon, YouTube. Good afternoon, Facebook. Great to be here live. Right, as we wait for people to come on, I'll give a minute or so for people to come on before we start. But I want to go through what we are going to be covering on this training because we've just had the spring budget. Let's be honest, there wasn't a huge amount of interest for us to be talking about. So what I'm going to do on this training is going to split down into a couple of parts. I want to pre-frame this training with my views on the UK housing market right now. That's pretty important. It's something I'm going to be covering a lot over the next couple of weeks. I think there's a lot of factors for us to take into consideration. Look at what's happened in the banking system, the banking ecosystem over the last week, because that's been fairly interesting. And then we're going to look at the budget announcements and see what there is of interest that we can take there as property investors, business people, to see what's relevant for that before we go into Q&A at the end. So as you come on, please say hi. Please put questions in as we go through. I'll try and answer everything. And obviously, if you're watching this on the replay afterwards, then you can't ask the questions, but still put stuff in the comments, and I'll try and answer them for you. So without further ado, let us crack on. And I'll go to the intro video as we wait for a couple more people to come in. Okay, so as I said, I want to start this by talking about the housing market. Look, I think we are being bombarded right now with information from the media, and quite frankly, it's pretty exhausting about what's going on in the housing market. Are we going up? Are we going down? Are we recovering? What's going on? Well, look, I put a few slides together to go through. So I think anybody could be forgiven to having a bit of uncertainty at the moment in what is going on in the UK housing market. Which direction is it going to go? And I put a post out on Facebook the other day. And I kind of want to delve into that a little bit, which is to beware of the headlines that you're reading in the media, right, mainstream media, and beware of making decisions based on, I would suggest, public opinion. Okay, I've got here just a couple of headlines that I found recently. Fixed rates, this is on mortgages, continue to fall as mortgage choice recovers. And one I saw last week, UK house prices are rising the most since June, Halifax says. So, you go onto mainstream media at the moment and it's like, right, what's going on? Mortgage rates are coming down, prices are going up. Have we had that little blip? Have we had a market correction? Are we going to make a buying decision now based on that? Now, something that I want to categorize is that everybody has a natural bias in their decision-making process. You might be very positive bias, optimistic bias. You might have negative bias. I personally tend to have a negative bias I personally tend to have a negative bias when I look at markets because I want to protect the downside. When I'm investing in property, investing in business, doing anything really, the first thing I look at doing is how do I protect the downside, or what is the downside? And then when I've mitigated the risk on the downside, I go, what's the potential upside? So I think one of the risks, one of the issues we have right now is if you're, for example, developing property, looking for properties to buy, to add value and sell on, to flip, same with businesses, going, cool, we're past this blip in the market, market's recovering, we can now go in and pay prices that maybe not realistic, okay? So that's the first thing to talk about is, what are the trends going on? And I would advise everybody to make sure you look at the trends of what's going on before making a decision, okay? So let's get back down here. So, if we analyze the first headline there, which is, mortgage rates are falling at the quickest rate that we've seen since all of September last year, right, when they went up massively in the mini budget. Here's a graph of what mortgage rates have been doing over the last several years, and you can see in this graph how they have absolutely rocketed up. From here, okay, to the peak, which was mini budget carnage, and yes, of course, they've come down since then, right? And anything that shoots up that quickly is going to have a blow off the top. And I think something that a lot of people don't understand is that mortgages are not necessarily priced as to interest rates. So this is, effectively the Bank of England base rate. Mortgages are not always priced on interest rates. Now, some of them are, tracker mortgages, potentially variable rate mortgages, but fixed rate mortgages will be done on something called the SONIA swap rate, which is effectively the institutions hedging in advance on what interest rates are going to do and then setting their fixed rates based on that. So yes, we have seen a pullback of mortgage rates, obviously, because they kind of blew off the top here when everybody thought, oh my God, this mini budget has gone crazy. We got rid of that. Mortgage rates have come back. But it's not enough data here to look at the trend of what's going to go on with mortgage rates. So I hear a lot of people in mainstream media and even in the property world going, mortgage rates have hit their top. They're going to start coming back down again. And I think a lot of people have a predisposition to think we're going to go back to having cheap money. Or some people think, look, we're going to certainly be pulling back. Now, I think that's a fairly risky strategy to be taking because we need to see the continuation of the trend. If we come down like this green arrow says, fantastic. Are we going to, sort of stabilize? Are we going to creep up, or are we now going to, go across, sort of trending a mean on these much higher rates for mortgages? Now, this is going to impact the property market. I'll dive into why in a minute. But let's go to this second headline here. UK house prices are rising the most since June, says Halifax. Right, let's analyse the Halifax house price index and see where they're getting that from. Now, if we look at month on month, right, this is the purple line here, we can see that they've had 1, 2, 3 month on month rises. Okay, so you might argue month on month, okay, we've bucked the trend here. However, if you look on quarter, we've had 1, 2, 3, 4, 5, 6, 7 quarterly downward trends. And we've had now one uptick on the quarterly price for the Halifax house price index. Okay, to me, 1 quarter, right, having an uptick is not bucking the trend. The trend for me, definitely here on the quarterly, is still going down. Okay, so we have to be careful about what headlines are going out. You see this headline? This is the Halifax put this out. If we look at something like the nationwide house price index, and we look at here, which is, what's that, October 22 to March 23, it's negative growth for the last 5 months on the nationwide. So nationwide is still seeing things dropping. Now, why is it important to understand the house price indices? Okay, Halifax, nationwide are 2 of the best known house price indices, but they are small data sets, okay? They are based on those companies' mortgage approvals, and they're factored for various things like seasonality, for example, but they don't cover, as an example, cash purchases. Okay, so they won't be covering any snapshot of the cash purchase market. They're also, when you look at them as a subset of all house purchases going through, house sales, it's a small set. So the biggest one is the UK house price index, but that lags a lot further. And the other thing about these is, we are trailing data, we're lagging data. So these house price indices are not too bad. They're probably sort of 6 weeks to 8 weeks. UK house price index is significantly longer in terms of a trailing indicator. So when we look at these house price changes, we're looking in a rear view mirror. So we're often not seeing what's going on at the time. And that's really important because we could be seeing huge price drops right now, but we don't know it for another 2, 3, 4 months, 6 months, 12 months, depending on what index we're looking at. So for me, that UK HPI house price index is the most important one, and that's the longest trailing one because that's going to have all the cash purchases. I read, for example, the Halifax doesn't include, Halifax doesn't include buy-to-let. Or is it the nationwide? One of the two doesn't involve buy-to-let. So as we see landlords exiting the buy-to-let market, we're not seeing the prices filter through on that. I can tell you right now that literally this week I've agreed a below market value deal on a mixed-use property in Chester, which has been in auction twice. The landlord was sticking out for over 400 grand. He's just agreed it to me for £350,000. So landlords, this is an elderly landlord motivated to sell. So we need to take a dose of reality into what's actually happening with the property market. Okay, if we look at a graph like this, this is a Wall Street sort of cheat sheet for psychology of a market cycle, more for trading stocks and shares. But look, this it goes for everything. We see markets go up very rapidly, then we have a drop, and then we have another little rise. Right, there's complacency because it drops off. We think the market's cooled off. We see in it a little bit of an uptick, and it's like, cool, we're resuming before we get to actual capitulation. Now, This is important to talk about because I feel in the mainstream media and I feel in all the property forums there's almost a bit of sentiment that we're out of the worst of it, that we've taken that downtick in the property market and that we're going to be resuming sort of an upwards trend again. Now we might do that. I'm not saying we won't. As I said at the beginning, I have a negative bias towards my investing decisions, towards what markets are doing. So my natural thought is that is not the case, that even though we might be seeing an easing of some of the metrics and the trailing indicators in the property market right now, that actually it's going to be short term. But we don't know. I'm not making predictions, okay? We will wait to see what the trend does. But for you to make up your own decision, we can't just be looking at what mainstream media is talking about. We need to understand a bit more about what the actual factors at play are on sort of a macroeconomic scale. So, I want to look at this graph here, which is the Bank of England base rate. And the reason I bring this up is because the last property crash that we had was in 2008, the financial crisis. We know this, right? If anybody's investing for that length of time, you remember what it was like in those times. But when we got to the financial crisis of 2008, which is, down here, and the property market started dropping, what happened to interest rates? Okay, we can see it here. They absolutely plummeted. So to prop up that market, interest rates were cut significantly down to, their historical lows that they've been for the last 15 years or so. Let's look at what's happening in the housing crisis now. The housing crash now. Okay, housing prices are coming down. What's going on with interest rates? They're ramping up. So we've got two completely different, circumstances in the two different house price corrections. It's fair to say that now is the first major house price correction since 2008. So last time, interest rates were cut significantly. Now house prices are coming down and interest rates are absolutely spiraling out of control. I say spiraling out of control. We're still at 4%. People say, look, 4%, it's not a lot. Compare it to, the 70s or 80s or 90s when interest rates were at 15 or 16%. I can't remember the source, but I saw an interesting piece of analysis that actually showed why when you look at affordability, interest rates here, sort of 4%, 4.5%, are actually more damaging and make it more difficult for somebody to service the debt based on a percentage of their income compared to when interest rates were 14, 15%, back in the 90s. So when I hear influencers saying, interest rates are still low comparatively, you have to look at it in the wider picture, which is in context of affordability. Okay, and that's what I want to delve into a bit more deeply, is affordability, because inflation, right, continues to be high, and we're about to get to one of my biggest bugbears, which is mainstream media talking about inflation peaking and coming down like the problem is solved and that's a good thing. Of course, inflation coming down is a good thing, but you can see, this is Jan 23, so I guess we're waiting for Feb 23 out to see where we are. But we've dipped, and I think up here is about, I can't remember what it was it 10.7, something like that, the inflation was. So we've come down about 0.6%, right? And of course, mainstream media go, peak, we've gone through the peak, inflation is coming down. It's still 10.1%, it's still double digits, right? So by inflation coming down doesn't mean prices are coming down. It means they're going up at a slower rate. And it's not really a slower rate when you look at it like this. Interestingly, I saw one of the things that Jeremy Hunt said in the budget today was their target was to get inflation to 2-something% by the end of this year. I think that'd be pretty staggering if they do that, but we'll, give them the benefit of the doubt. Let's see how it goes by the end of this year. Rishi Sunak said a week or two ago that their target was to halve it this year. Now, if you halve it from here, 10.1%, we're still going to be here. What's that? 5? Let's call it 5%. 5% is still 2.5 times the target, right? It still means prices are going up, albeit at a slower rate than 10%. Inflation coming down from its peak does not mean that prices are going down, so that everything is still getting more expensive, right? Why is this relevant to the property market? I know everybody who's peddling courses out there says inflation is awesome because it erodes debt. Yes, it does erode debt, right? But in terms of property prices are dependent on people's affordability, right? Prices are linked to what people can borrow. We've just seen interest rates, rocketing up, and we've got a cost of living crisis, inflationary fueled. So people's affordability is going down, which means they can borrow less, which is going to have a direct impact on property prices. Okay, when I put these two things together, I cannot see how prices can suddenly resume going up over the over this short to medium term, i.e. 2023. It's a combination of factors that surely will crunch together. I say surely, like I'm telling you, I'm not making any predictions. I'm just looking at the data, right? Let's talk about interest rates then, because we've got a monetary committee meeting next week. It's going to be interesting to see. I'm going to talk a bit more about interest rates in a little bit, based on the banking crisis that is unraveling or sort of unfolding in front of us right now. But I want to make a point about interest rates. So we're at 4% now. This time last year, so this slide, I just found this when I was researching this slide. This slide was published, or this report was published March the 22nd, 2022. So this is less than a year ago, okay? Less than a year ago. This was by a professor of finance in the University of Liverpool, and he talked about interest rates are likely to rise by much less than people are expecting. Now, at the time, in his report, this is what the market expectation of interest rates was less than a year ago, okay? So where are we now? We are in 2023 here. The prediction was 2%. So this time last year, interest rates were predicted to be 2% right now. Peaking at what's that? About 2.2% at the sort of end of this year, month 7, right? That was less than a year ago, the prediction. Now, this report actually said that they thought it was going to be less than that, right? They actually thought that 2023 Q1. His estimate was 0.4 to 0.8%. Okay, that was their prediction as a university of professor in finance from the University of Liverpool. That was the prediction. Now let's fast forward. Let's go to the mini budget. Okay, so when we had this mini budget, the forecast jumped up to, here we go, 5%. And I think at some point people were talking about 6.5%, and that's tailed off a little bit. But the summer interest rate prediction, if we look at here, would be, where are we? 2023 here, 3%. So we're at 4% with potentially going up again next week. Why am I going through all of these, right? The point is, the prediction on interest rates are changing all of the time. Nobody knows exactly what's going to happen to interest rates because they're affected by so many factors, right, that we're not aware of. So we'll talk about the banking, the Silicon Valley Bank in a minute, right? But if you remember last year, we had the invasion of Ukraine. We then had mini budget. There are external factors that come in and affect what is going on right now with interest rates. So it's very difficult to actually predict what's going on with interest rates. But what is important to understand, right, or from my point of view, what I believe is important to understand is that I do not believe interest rates are going to be coming down massively anytime soon. If we look at the SONIA swap rate, now I don't want to dive into exactly what this means, but basically what banks will do is they will hedge, they will lock in rates in years in advance. So when you're getting something like a 5-year fixed rate mortgage, that's not going to be priced in based on the current Bank of England base rate. That's going to be priced in based on the SONIA swap rate. So this was taken last week, this screenshot, where the 5-year SONIA swap rate, you can see here, is 4.03%, was where it's sitting. Interestingly, a year previously, 7th of March, was sitting at 1.5%. So you can see how much it came up in a year. So last week, the banks were betting that in 5 years' time, you'd be at sort of 4%, okay? And you can see 7, 10, 15, it's coming down a wee bit. But for me, those interest rates are going to be sitting there persistently high. And this is, again, extremely important piece of information to understand what's going to happen in the future, to future pace what goes on, okay, in the property market. Because the second reason that I've heard people, influencers, talking about why there won't be a property market crash is that there's lots of people in with fixed rate mortgages right now. Which is true. So if you think about the boom and era of super free money, where government was giving away lots of free money post-pandemic, 2021, 2022 saw a huge boom in property prices. Lots of people had access to money. There was huge quantitative easing, lots of money sloshing around. People were buying property with cheap debt. Okay, a lot of people in the UK fix in on 2%, a 2-year fixed rate product. 2021. Fast forward 2 years is 2023. 2022, fast forward 2 years is 2024. This graph, this diagram, shows the amount of people who are ending their fixed rate period, okay, in these various quarters. So you can see, and this is the fixed rate period with what they are fixed on, okay. So if you're looking at the cheap money, 2 to 2.5%, under 2%, these are the number of people that are ending, okay, their fixed rate mortgages. So we are in Q1 2023. So you've got in there over 200,000 people are coming off a fixed rate of under 2%. And you've got, what's that? So that's 2 to 3. That's about another 100,000 people are coming off a fixed rate of 2 to 2.5% in this quarter. Next quarter, another 210, 20,000. You know, you're talking in total there, 360 odd thousand people in the next quarter coming off sub 2.5% interest rates. And this starts to obviously tail off as we go into 2024. But these are hundreds of thousands of people every single month coming off very cheap fixed rate deals, okay? And what are they going on to? Well, if they have to refinance and they have to go through that process of refinancing their property, then they're going to have to go through affordability stress tests again. If they stick themselves on standard variable rate, you can see down here, currently, in fact, well, currently, this was taken last week. This was on the best money deals out there on comparethemarket.com. Standard variable rate, 7.49%. Okay, so people are potentially coming off sub 2% interest rates on their mortgages and going on standard variable rates of 7.5%. Okay, that's going to be a huge shock to their affordability as well as the cost of living. Okay, inflation still going up, cost of living still going up. Let's go on to the energy price cap, because this is another factor that affects the cost of living. Energy price cap. Now, again, I see lots of people talking about, look, wholesale prices are coming down. They've come down hugely. Why are our bills not going down? This is the reason our bills are not coming down, because we've got the energy price guarantee. So this line here, okay, this line here is what would be happening if we didn't have the energy price guarantee in place by the government, okay? So if the government hadn't put the energy price guarantee in place, our bills would have gone from average, what's that, 2,500 to 4,000. But the energy price guarantee here, we've been sitting in this area, right, has kept our bill standard, because the wholesale price, let's say it's all the way down here, and it comes down to here because it's dropped a lot, it's still above the energy price guarantee. Now, in April, so in a couple of weeks' time, this was going to ratchet up by about £500, £500 a year. Something that's been announced in the budget today is that's not going to be ratcheted up. So if we just undo that, what's going to happen is it's going to stay level where it is. However, we can analyse this in a bit, but my gut feeling is that's a real headline-grabbing quick win for the government, because what are we about to go into? April, May, June, we're into spring and summer months. People aren't using a lot of energy, or certainly huge amounts less in the winter. And this is only for another 3 months. So they guaranteed it for another 3 months, which takes us to there. For me, the real litmus test is what's going to happen next winter. And I made a prediction last summer, so that's summer 2022, that the real effects on the housing market would be felt in winter 23-24. Okay, because there's so much lag in this system, because we've got people on fixed rate mortgages, because people, you know, might have some spare cash hanging around. You can get through that first winter when everything's this high. I can tell you what's happened to my energy bills as I've moved to a house. So have come off the fixed rate from my previous house onto a variable energy rate on my new house. So we've been rationing gas and electricity over the winter, which has been exciting. It's next winter, the second iteration, I think people will really be hit. So, you know, if we look at this, if we look at the amount of people here, right, coming off their fixed rate mortgages, we look at winter. Let's go here, you know, winter with energy. And I have no idea what inflation is going to be. I'm not going to make a prediction on it. But what I can tell you is there's going to be a lot of people on a lot more expensive debt. There's the cost of living crisis. Sorry, I keep hitting my mic. The cost of living crisis is not just suddenly going to go away. Okay, it's probably going to get worse into next year, unless the trends change. And this is something I want to be very obvious about, right? Trends can always change. At the moment, I'm seeing trends get worse, get less affordability. Trends can always change. We'll talk about that in a sec. However, that combination of factors for me is a perfect storm of factors that are crunching people's affordability, right? And as I said at the beginning, property prices are, why do I keep hitting that? Property prices are based on what people can afford to borrow. If people can afford to borrow less, and that's purely objective, I cannot see how people can suddenly afford to borrow more unless everybody's wages spiral out of control. But looking at the fact there's loads of people striking today, again, I think that might be unlikely across the country. Okay, so when you look at it, crunch in affordability means people can borrow less. People borrowing less means by default property prices will come down. Okay. And the thing that I don't hear anybody talking about in mainstream media is the effect of inflation, bearing in mind that we're in a high inflationary environment right now, and property prices are coming down in actual terms, right, in actual figures. So when you adjust this for inflation, they're actually coming down fairly quickly. Okay, so if we have a look at this, okay, this is only to the Q4 2022. So I'm looking forward to seeing sort of the next quarter come out. And this is from the Nationwide, but this is an inflation adjusted house price graph. Okay. Now, to me, that dip there, when house prices are adjusted to inflation, is fairly significant. Okay. It's fairly significant. And when we look at the factors that I've just talked about, or more people coming off cheap fixed rate money, cost of living continues to be a burden on people. Okay, are we seeing a blip? So if we go back to here, are we seeing a blip before the downtrend returns, or are we seeing a genuine reversal? We don't know. I'm not going to make a prediction, right? I'm not going to make a prediction. Time will tell us, and in 12 months' time, we'll be doing this live, and we'll look back and going either, oh look, property market has returned to status quo, or inflation adjusted prices have gone down 30%. Who knows? I don't know. Why is this important? Okay, this is important to understand because if you are a property investor, indeed a business investor, and any investor, and I'm live streaming right now onto my YouTube channel and Assets for Freedom. By the way, guys, as you come on, I can see there's people on here. Say hi. There should be a link on the post that you can authorize your name to come on. I want to get as much engagement as this as possible. This is part of our mastermind community. So this is free sessions, free time. I'll probably go to main camera so I can look at you. I'll probably take my glasses off as well because you probably see a horrible glare in the glasses. This is your opportunity to get some free input Q&A sessions. So say hi on the notes. And by the way, let me know if this is interesting or not for you. Okay, because as a property professional, when you're just getting started, you're super experienced, you need to understand what's going on in the market, okay? Because if you're looking at doing developments, right, if you're looking at doing flips, is now the time to buy. Of course, we can find opportunity anywhere, but we need to be able to adjust our purchase prices to cater in for what could be significant drops this year in 2023. Now, as a, hey Dino, how you doing, buddy? As a property professional, right, when I look at graphs like this, that to me is opportunity, right? It's opportunity. And I don't say that in a bad way. I don't mean take advantage of people who are going through issues. This is happening for a variety of macroeconomic reasons. But as a property investor, right, if we look at the last time this happened here, I started investing in property, I would say, no, sorry, that's wrong. There. So I started investing in 2011. Oh, my thing stopped working. I think I've turned my pencil off. That's frustrating. 2011, I bought my first property. So about there, okay? So I timed it very nicely. Okay, so my portfolio has ridden up that wave. I'm going to let you into a little secret, okay? I sold my personal house there. It's actually probably it's probably about there, actually. I sold my personal house in December last year, December 2022. And I did it on purpose because I went through a choice where I could hold on to it. I'd relocated, right? So I relocated from up north to down south. My house is up north. I had an opportunity to keep it and rent it out, or to sell it and release the equity to then reinvest. Now, I called this last summer, this correction. And so I scrambled to get my house on the market before the dip happened, and we got it away. Now, time will tell whether that's a good plan or not. But what it did is release a war chest of cash, which I'm holding on to right now, to then look for deals as we go into potentially this. And look, it might do that, right? It doesn't matter if it does that, because I've still got rental portfolio. What it will do, whatever it does, you'll go down somewhat and then come up again, right? Because that's what property does. I say that. I don't guarantee it. It could do that and never come back. Unlikely. Okay. Whatever market cycles go for, if we're going down, it will come back up at some point. Now, that takes us to talking about market timing, and I don't want to really go onto market timing today for the main reason that I want to look at, I'm talking about the market and the events that are happening in the world at the moment, and the budget, rather than property strategy. We can do that on another live stream. But the point is, my bias is conservative and negative. I think we've got quite a lot further to fall. However, that creates opportunity. I wouldn't personally be touching developments, flips, anything like that right now because I think it's too much risk. However, as I see investment grade properties come up, this is what I'm now looking at buying. Got offer on the first one agreed this week, as I said at the beginning, for a significant discount on the market value. It's an excellent one. We'll talk about it some other time. Right. That is my honest opinion of the market, the property market right now. I think we're in for further dips, potentially quite large ones in 2023. It's not a prediction. It's my personal view, and it might be completely wrong. Let's talk about something that might change that or might affect it, because all of this is talking about trends, okay? So at the moment, we're in a downtrend. Yes, there might be Halifax might be saying there's a slight uptick, but as far as I'm concerned, that's not broken the trend. Don't forget, if we go back to the Wall Street cheat sheet here, we've got nothing goes up or down in a straight line. Down, blip up, trend, okay? Trend for me is down. Now, there could be significant world events that change trends, things that we haven't anticipated. So let's talk about what happened last week, or is happening at the moment, unfolding in front of us with Silicon Valley Bank, right? And what's going on there? I don't know if anybody's keeping tabs on this. It's interesting because all over the weekend, all the media's been talking about is Gary Lineker. Nobody's really been talking about what's been happening over in Silicon Valley because they think, oh, it's Silicon Valley. It's in California. It doesn't affect us, even though it's a UK arm of Silicon Valley. So if you haven't been keeping tabs on it, this is a really interesting story. And it has the potential to create a new banking crisis. What happened in the last banking crisis? It was a massive poo show, wasn't it? 2008. There was contagion and everything happened and spiraled very quickly. What we've seen with Silicon Valley, right, is potentially the first domino in a bank crisis, or it could be a little blip that's completely isolated and has no effect on anything. But let's just go through what happened here. So Silicon Valley Bank is a bank that services a lot of tech startup clients. Now, I don't know what you know about the banking system, but we operate something called a fractional reserve banking system, which means we put deposits into the bank, right? Savings, money sits in our bank accounts. And then what the bank does through some various complex mechanisms, I don't want to try and explain here because I'll probably make a mess of it. What they do is they then lend your deposits out, right? Generally at a higher rate to what you are getting from your deposit in there. And there's lots of mechanisms that actually multiply this and can lend out a lot more than they got on the balance sheet. It's quite an interesting, if you don't know a lot about banking, I suggest you research it. It's quite an interesting thing. So what does this mean? Let's say we've all got, 100 grand sitting in a bank account in Silicon Valley Bank or any bank. Theoretically, we could go and take that 100 grand out whenever we want. It's our current account, right? But the bank has probably lent a significant proportion of that out. Mortgages, lending, buying bonds, things like that. So if everybody comes on the same day and asks to take their 100 grand deposit out, the bank's not physically going to have it in the bank account. Okay, this is an issue and lots of people want their money at the same time. Now, what has happened here is that 2022 has been an absolute red riot for tech, right? Tech is going, has nosedived in terms of, share price and performance. It's interesting. I saw an article yesterday with Facebook laying off something like 10,000 people. I've got a good friend who lives down here who's in marketing. He said for the first time they're starting to struggle. So, the dominoes are starting to line up here a little bit. Anyway, a lot of tech companies have been struggling. They've had a bad 2022, and so they've had to go in and take out some of their money just to do things like keep the lights on, make payroll. And because lots of them have been doing it at the same time, right, there's been a liquidity issue in Silicon Valley Bank. So what they've had to do is liquidate some of their assets to be able to pay out these withdrawals. Now, a lot of their assets or a lot of their portfolio is tied up in bonds, traditionally very safe investments, but 2022 interest rates have been rocketing up. Now, there's an inverse relationship with bonds. So when interest rates go up, value of bonds go down. So what's happened is if Silicon Valley Bank had just been able to leave their bond portfolio to maturity, they'll get their capital back because they've had to liquidate at the worst possible time. They've made significant losses on some of their assets they've had to sell to be able to have the liquidity to pay withdrawals that are going on. Now, what happened is they have a duty to report this. So they've had to liquidate a load of their bonds. That at a significant loss, they've had to report that to the market. The market has gone, oh, bugger. right? They've got a liquidity issue because they're selling assets significantly undervalued. Everybody goes, I need to go get my money out now. And this is what creates a run on the banks. So within 48 hours of them announcing they've had to sell these bonds off, okay, you've had a run on the bank, and effectively the bank has collapsed in 48 hours. Now, what has now happened, the government, the Fed in America, has not bailed out the bank. What they have done is they've guaranteed, this is interesting, they've guaranteed everybody's deposits in there. And that's kind of like a trickle-down economics thing, that they don't want all the tech companies to suddenly lose all of their deposits or all their money, because that would have significant impact on the economy. And I'm not quite sure what's going on in America, but certainly the UK arm of Silicon Valley Bank has been bought by HSBC. So that immediately, the sort of deposit balance book of a bank like Silicon Valley Bank UK is pocket change compared to something like HSBC. So they bought it. I think they bought it for £1 or something like that, and then they instantly basically capitalise it and give it liquidity. So let's cut to the chase. There's the overview of what's happened. So the first question is this the first domino of a wider banking crisis? Like I haven't even shown. Sorry, it's down on the iPad. I'll flick you down on the iPad. Doesn't really matter too much. Is this the first domino in a wider part of a financial banking crisis? Because what happens in these runs is contagion sets in. People who bank with other banks suddenly go, oh, bugger, these guys have gone, are ours about to go? And they go and do exactly the same thing. Feds or the government, in the US, have stepped in and said they will guarantee everybody's deposits with Silicon Valley because they don't want that to happen. They don't want the contagion to set in. But what it has shown, okay, is this rapid rising of interest rates has got consequences. And what the centralized banks and governments don't want to happen is the entire banking system to crash by continuing to ramp up interest rates at the rate they have been going. Okay, so that puts a little bit of a dilemma in. So do we carry on rising interest rates quickly and potentially topple the banking system, or do we cool it off, right, and let everything catch up a little bit? Basically, what that means is, will interest rates continue going up? The answer is I don't know. But let's have a look at this. So I showed you earlier this SONIA swap rate. So this was taken last week, 7th of March. 5-year SONIA swap rate last week was 4.03%. I just took this screenshot just before coming to deliver this training. Okay, 5-year SONIA swap rate, 3.72. Now, actually, in a week, that is a massive change. Okay, it's a big change. And that has happened because a lot of the analysts are now thinking, probably quite rightly, that interest rate hikes will have to slow down to not topple the banking system. So what do we do? Topple the banking system, leave interest rates as they are, start to cool it off. If we cool it off, right, that is going to affect inflation. So by cooling off the interest rate rises, and I think next week's going to be really interesting. Okay, so we've got a monetary committee meeting next week, which is going to be deciding if we go up again. Certainly, last week people going, it'll probably be the last rise, maybe 4 to 4.25 or 4.5. I think it'll be really interesting what happens next week, and what I suggest we do. It can't be next Thursday because I'm traveling up north. So maybe the week after we do another live stream and talk about the rate rise or lack of rate rise, see what happens. But I think it's going to be very interesting. Now, does this create relief for the property market if interest rates aren't going up so quickly or start to reverse? Who knows? Only hindsight can tell us this. I think what is interesting is if the interest rates don't continue going up, what's that going to do to inflation? Don't forget, if inflation is high, right, I can't suddenly see property prices reversing. Inflation is high. Real term property prices will continue going down because they're getting eroded away from inflation, right? So if over the next year, property prices are reported to reduce by, 1-2%. When you factor that into inflation, you're actually talking, 10%, right? Yes, I know we're inflating away our debt as well. I'm not talking about that. I'm talking about house prices. So this is interesting. So it's going to be an interesting thing to watch, and we'll look at what the trend happens. Anybody, by the way, as we go through this, please do ask questions, guys. Please do put some comments. It's always nice to have some interaction. What I have done is fixed the internet with a Ethernet connection, which is this interesting? Is this useful for us in the Assets for Freedom Mastermind group? Are we getting some value from it or not? Let me know. Next time I'll probably bring in some water. Right, so we've talked about my views on the property market. We've talked about what's going on with Silicon Valley Bank. Let's keep our eyes peeled on what happens with that. Let's talk about now let's talk about the budget that has just come out. And I've got to be honest, there's not an awful lot to talk about. So let's see. I've just taken some snapshots. I want to kind of focus on things that I think are interesting for us as investors in the investor community. I mean, the first thing that's very obvious is they've changed a lot on the pension stuff. Now, I've not seen any of the detail of this yet because it's obviously just been announced. But it looks like they've taken the lifetime cap, which was 1.07 million, to be abolished, which actually is great. That's great news. And changed the tax-free allowance from 40,000 to 60,000. I think they have to do that because inflation has gone up so much. If it's 40, if they keep it at where it was. Don't forget, it used to be. I can't even remember what it used to be because it used to be before I was putting money into a pension. But it used to be hundreds of thousands a year was your tax-free yearly allowance. Okay, so look. They've abolished the lifetime allowance. They've put up what you can put in every year from 40 to 60 grand. This is a bonus to us. Something that's really important in property and business is not about how much money you make. It's about how much money we get to keep. So we're always looking for ways of how we can mitigate taxes, because taxes is probably one of the biggest things that's going to take money out of your pocket, other than just spending on ridiculous liabilities like Lambos and things like that. Okay, so your pension allowance is probably one of the easiest ways that you can that's wrong. Keep a lot more of your money. Now, yes, if you're putting money into a pension pot, of course, you don't have it available. But do you? Because there are strategies out there that we can utilize our pension pots through SIPs or SASs, and we can continue to invest in various property types. Again, I'm not going to go into that now. But I think it's a good thing to be able to put more money into your pension and then invest that through a SIP or a SAS into various either loan or property assets. Okay, that's kind of cool. I'm not too interested in talking about fuel duty or alcohol taxes to come down, but draft beer is good. I'm kind of hoping that my Beer Hawk keg system will be classed as draft beer. Now, let's talk about energy, because they made a really big thing about this. Okay, made a really big thing about the energy. So if we just go back to this graph, let's just refresh about the energy price guarantee that we've been on since I think it was September last year. So we've been on this amount of energy price guarantee, and in April it was forecast to go up about £500 a month. Okay, so that was going to make it more expensive for everybody. Because our prices of utilities would go up again. I said, despite the the fall of wholesale gas prices, it's only kind of going up from there to there, which means we're still not benefiting from that. But the energy price guarantee was going to go up, which means we would pay a little bit more. The other thing to bear in mind with this is that I can't remember the name of the scheme, but the £300-400 that they've given us every month, 67 quid a month for 6 months, also is now ended. Okay, so that's actually fallen by the wayside. So it was a double whammy of that ending and the price guarantee going up. Actually worked out to about, I think it was about £1,100 a year it would go up. So they've kept it. They've kept the cap for the next 3 months, but 3 months, right? April, May, June. We're not going to be burning through gas. As I said, I think this is a headline grabber. I don't think it's actually going to save that much. I'll be interested to see the detail. As I said before, for me, the real litmus test is what happens in October this year, okay, in terms of energy. But, right, it's better than nothing, right? It's a little bit, isn't it? Okay, so that was energy. Now, let's have a look at public finances. This is what I thought was really interesting. It was this statement here, that UK inflation rate is predicted to fall to 2.9% by the end of this year. I'd love to see that. I'm not sure I can see it happening, but look, we'll wait and see. And then the only other thing that's of interest to us is business and trade is confirmation that the corporation tax is still going up from 19% to 25% in April. So this is another thing. So your taxes are going up. Don't forget, this is a tiered system. Okay, so you can see companies with profits in 50,000, 250,000 is going to ratchet up. So if you're 50 grand or less as a company, okay, you're still going to be on 19%. Anything over 50 grand is going to ratchet up to 25%. So as ever, look, you want to minimize your profits that you declare in your company. Pension, putting more money in your pension is something that you can do that. I'm going to do a video, not a live stream, I'm going to do a video about legitimate ways that we can reduce that profit and therefore a corporation tax bill. Because there are lots of great schemes out there, and he's talking about something here. Companies are able to deduct investment in new machinery and technology to lower the taxable profits I really want to see what the detail of this is, because we've always been able to do this. And we have at the moment a £1 million annual investment allowance where you can invest into plant and machinery and offset it against your corporation tax. Now, this annual investment allowance is very interesting if you're into something like commercial property, commercial conversions, HMOs, because there are elements of that we can claim against this allowance, right? They're called capital allowances. I'm not going to dive into it right now, but suffice it to say, we can put capital allowances claims in under this scheme, right, to be able to reduce our corporation tax bill, which of course puts more money in our pocket at the end of the year. It's not about how much you make, it's about how much you keep. That's the most important thing. The more you have, the quicker we can compound it to grow our wealth. And I'm going to go, I think I'm going to go quite deep into it because as you, well, I don't know if you do know, I'm in property, but I'm also in business, and my business that I'm building at the moment is a scaffold company. So there are allowances, these sort of annual investment allowances, capital allowances. We've got various super allowances that were put in a couple of years ago, which means you can claim over 100% on this against your tax bill. Don't forget, it's not like you can claim if you buy 100 grand's worth of kit, they're going to give you 130 grand back. No, that's not how it works. So 100 grand is offset against your corporation tax bill. Okay. So we've been using those quite extensively to reduce the profits in that scaffold business, which is a really interesting way of doing it. So we'll go into that in a lot more detail, okay, in a different video. There were also, various other little bits, defence spending up, but I wanted to focus on what things are relevant to us as property and business people. And the honest answer is it's not a huge amount, right? There's nothing in there for property. All I would say is make sure you know about everything that's you have that's entitled for you that you can claim against, right? Again, I'll put some videos out in the future about all of the allowances, because I know, look, a lot of people bash government and say, look, they're ripping property market to shreds, and they are to a certain extent, Section 24, EPC stuff coming in, but there's also lots of ways. If we know the game, if you know the rules of the game, we can play it. Right? If you don't know the rules of the game, we can't play it properly. If your investment strategy is tailored towards what's out there, I want to give you an example. In fact, this is just sort of off the cuff. I want to give you an example. This property that we've just had an offer accepted on that we're buying is a mixed-use property, retail downstairs, 4 flats upstairs, okay? One of the reasons I'm going to go up here, sorry guys, I'm going to put this iPad down because it's hurting my hand a little bit. One of the reasons I absolutely love mixed-use buildings is because of things like stamp duty. So for a start, we don't pay 3% stamp duty surcharge, even though we've got 4 residential units in there. And that's been ratified, right? Because I know there were some discussions about should it be charged, but it's not, right? HMRC advice come out and said mixed use building will not charge us the 3% surcharge. Other things we can do is we have multiple dwelling relief on this, okay? Now, a lot of solicitors don't even know about this. I just got a quote from my solicitor for the conveyancing, and they put the wrong amount of stamp duty on there, okay? They just did a commercial building stamp duty, but they didn't apply multiple dwelling relief, which again, there is case law that you can do this. So knowing the rules of the game are so critical to drive your investment strategy. And yes, I know they do things like retrospectively change stuff like Section 24. Yes, they do things like change tax changes, but just look at the market we're in. Okay, I'm going to go much more into this over the next few months about what people should be looking at. I'm going to put a video out about buy-to-let and is it dead. My personal view is single-let buy-to-let, right, is difficult if you are using finance, okay? Section 24, all that sort of stuff, it's more difficult to make it work. Higher interest rates. I'm not saying it's dead, right? People, loads of cash to invest, just go and put it somewhere safe, like single-lets. Awesome. That will always be there, okay? That will always be there. But for people who are leveraged, people who are using investor funds, bank funds, it's going to be difficult to make single let work with the higher interest rates, Section 24, all that sort of stuff. There's so many great strategies out there that we can use to increase our cash flow, to increase our value add, to be able to recycle funds out. And I don't care what interest rates are. If I get all my money out, right, as long as I'm making some money at 10%, 15%, I don't particularly care what the interest rates are, right? As long as we're still making money, because that opportunity is going to be there, right? My view is the opportunity is older baby boomer landlords exiting the market, lots of exciting, interesting mixed-use buildings, blocks of flats, large HMOs, commercial units, which we could buy, for significant discounts in this downturn. reconfigure into HMOs, reconfigure into multiple commercial units, reconfigure into boutique, apart hotels, which is my strategy. Really super cool. Okay, there we go. That's my view on it all. Right. Have we got any questions, team? I know I've rabbited on for quite long enough. What time is it? It's 4:50 and I have got 5 minutes before I've got to go to a squash game. So, number one, was that useful for everybody? I think that live stream worked better this time than last time when the live stream kept on popping out. Was it useful? Do you have any questions? Is there anything that you want to add to the conversation? This should not just be me talking to you guys. We are a mastermind group in the Assets for Freedom Facebook group. And by the way, if you're watching this on YouTube, there'll be a link somewhere if you want to come join the community. It's a free community, which I am building for people who are looking to increase their wealth in assets. By the way, if you're also watching this on the YouTube or Experts for Assets for Freedom group, and you want to get regular notifications of the videos on YouTube, please do subscribe. That always helps. Any questions from my team who are here before I pootle off and go and play a game of squash on this rather chilly still Wednesday evening? Anybody for anything? Make the most of the opportunity. I'll give it a minute. I think I've spoken enough. I know there's always a bit of a lag on putting comments in and stuff like that, isn't there? Okay. Last chance. Team, it's been an absolute pleasure. I will see you on the next live stream. Quite enjoying doing these. I will sign out and see you on the next one.